Welcome to the Deep Dive. Today we're tackling a really interesting story in Indian retail, DMart.
Yeah, it's fascinating, isn't it?
It really is.
Yeah.
Because you look around and everyone's doing flash fails or, those super fast 10-minute deliveries.
Right, chasing the hype.
Yeah, exactly. And then there's DMart, just stubbornly different, but also incredibly successful. It's a bit of a paradox.
It really is.
So, our mission today is to, cut through that noise. We want to understand what really makes DMart tick. We've gone through all the source material, all the reports, and basically boiled it down to 7 essential questions.
7 key questions.
Yeah, and the idea is if we answer these, you, the listener, will get a really solid, comprehensive understanding of this unique retail giant. Think of it as a shortcut to being properly informed.
And that's the goal here. This isn't just about reciting facts. We're exploring the meaning behind DMart's strategy, the implications. We'll uncover some of the hidden gems in the data. It's not just what they do, but really digging into why it matters for them and for the Indian retail scene.
Okay, sounds good. Let's jump right in then. First essential question. What exactly is DMart's unique core business strategy? And how has it let them succeed as this retail paradox in India?
Okay, so at the absolute core, it's all about their everyday low price philosophy, EDLP.
EDLP, right.
And importantly, this isn't just like a pricing tactic they pull out now and then. It is the bedrock, the foundation of their entire business.
So how does that differ from, say, a typical supermarket?
Well, most competitors use what's called a high-low model. Prices are higher generally, but then they have big sales, promotions, discount weekends.
With big red signs everywhere.
Exactly. DMart avoids that. Their promise is consistency. The price you see today is likely the low price you'll see tomorrow and next week. Always low.
And who are they targeting with this?
Primarily India's huge middle and lower middle class. These are shoppers who are very price conscious. They often make repeat purchases of the same essential items.
They value consistency over frills, fancy displays.
Precisely. They value getting the best price reliably. And DMart delivers this through, what you could call radical cost control, an almost unmatched obsession with operational efficiency.
Okay, break that down. What does radical cost control look like at DMart?
Well, a huge one is real estate. They own nearly 90% of their store properties.
90%? That's unusual in retail, isn't it? Most lease.
Extremely unusual. And it's a massive strategic advantage. It means they avoid unpredictable rent escalations. It locks in a low operating cost, sort of, permanently.
Okay, that's a big one. What else?
Location strategy. They deliberately choose non-prime spots. Think high-density suburbs or Tier 2, Tier 3 cities. Cheaper land, cheaper to build or buy.
But still, lots of people nearby.
Exactly. Rich in footfall, low on acquisition cost. There's the in-store experience. It's frugal. Warehouse-style stores, minimal staffing, very lean design, no fancy tech, no unnecessary gadgets.
So no chasing trends, no splashy promotions?
None of that. They resist the urge to lure customers with short-term discounts or high-tech gimmicks.
So all these savings, where do they go?
They go right back into the prices. Nearly every rupee saved on rent or operations or advertising, which they barely do, gets reinvested to keep those shelf prices consistently lower than competitors.
By how much, typically?
Often by a significant margin, maybe 6 to 7% lower.
Wow, okay. That's a clear competitive edge built purely on cost discipline. It seems like this reinvestment keeps the cycle going.
It really does. It reinforces that core EDLP promise. And that discipline, that focus, leads us right into our second question. Because that real estate model and their supply chain are absolutely critical here.
All right. So question 2. How do DMart's unconventional real estate ownership and their supply chain management actually contribute to making this everyday low-price philosophy work?
Okay, let's dive a bit deeper into that 90% ownership. We mentioned locking in low operating costs, avoiding rent hikes. That's huge compared to rivals who are mostly leasing.
And paying escalating rents year after year.
Exactly. But there's another angle. Owning the property allows DMart to be incredibly patient. They don't need every single new store to be profitable from day one.
So they can take a longer view on a store's success.
Yes, they can wait for a location to mature, for the customer base to build. Lease stores often face pressure for much quicker returns. This long-term thinking baked into their assets is fundamentally different.
That makes sense. And I've heard about their expansion strategy being different too, this cluster-based approach.
That's right. It complements the ownership model perfectly, instead of just planting flags randomly across India.
Which many retailers do.
Right. DMart focuses intensely on one region. They started in Maharashtra, for example, and really saturated it. Built lots of stores, distribution centers, brand awareness there before moving significantly into new territories.
What's the big win with that strategy? Scale benefits?
Absolutely. You get huge scale benefits in distribution, shorter truck routes, fuller trucks, better brand recognition in that specific area, and it allows management to stay focused, not spread too thin.
But it sounds slow
Hmm.
compared to rivals aiming for a national presence quickly.
It is slower. They add maybe around 45 stores a year. It's very deliberate. They prioritize sustainable growth and, crucially, profitability per square foot, not just grabbing market share for headlines.
Slow and steady wins the race, perhaps. Okay, what about supply chain side of things? How does that feed into low prices?
Precision is the word there. They run over 62 distribution centers now. They use an auto-replenishment system, which means stores get restocked automatically based on sales data.
High tech behind the scenes, even if the stores look basic.
Sort of. It's focused tech. The goal is high inventory turnover, getting products onto shelves and sold quickly and minimizing stockouts. Nobody likes an empty shelf.
True. And how do they get the products into those distribution centers?
A lot of direct procurement. They try to buy straight from the manufacturers, cutting out wholesalers and other intermediaries wherever possible.
Squeezing out costs at every step.
Every single step. And this brings us to a really notable aspect, how they treat their suppliers.
Ah, yes, you mentioned the cash-first model earlier. What's the deal with that? Paying suppliers quickly.
Much more quickly than the industry standard, often within days compared to weeks or even months for competitors.
Why do that? Just to be nice.
Well, it builds goodwill, but it's intensely strategic. By paying fast, DMart secures better purchase terms,
Right.
lower prices from the supplier.
Okay, makes sense.
But even more importantly, it guarantees them priority supply. Think about times when there are shortages, maybe a raw material issue or sudden high demand. Who do you think the supplier looks after first?
The one who pays reliably and fast.
Exactly. DMart gets first dibs. It turns a simple transaction into a real strategic partnership. It ensures they have the stock others might struggle to get. It's a huge, often hidden advantage.
That is really smart. Okay, so we had the low prices logged in through costs and supplier relationships. But what about the products themselves? What role do DMart's own brands, their private labels, play? That's our third question.
Right. The private labels, they're a crucial piece of the profitability puzzle. While EDLP is the customer-facing promise, these private labels brands you might see like DMart Premia or Save More, Minimax.
I've seen those across different categories, right? Staples, cleaning supplies.
Yes, staples, home care, personal care, even apparel. They operate across many key categories, and you could call them DMart's quiet margin machines.
Quiet margin machines. Why?
Because their function is pretty simple. Offer quality that's comparable to, sometimes even better than, the big national brands, but sell it at a lower price point.
Okay, still fitting the EDLP model.
Yes, but here's the crucial insight. These private labels deliver much better profit margins for DMart compared to selling the national brands.
Ah, I see. So they make more money on each private label item sold.
Significantly more. This directly boosts DMart's overall profitability without needing to raise shelf prices for the customer. It actually helps them reinforce their price advantage because they have more margin to play with overall.
That's clever. They maintain the low price image, but improve their own bottom line simultaneously. Is there a risk, though? Like, if they push private labels too hard, do the big national brands get annoyed? Or do customers sometimes just want the famous brand?
It's definitely a balancing act. But so far, DMart seems to manage it pretty well. Because they sell such huge volumes, even national brands still really want to be on their shelves and remember their target customer.
Price conscious, values consistency.
Right. For that shopper, if the quality of a DMart brand staple or cleaning product is good and the price is noticeably lower, that value proposition is incredibly strong. It usually wins out.
Makes sense for their core audience. Okay, so the model seems incredibly strong, very disciplined, but no business is immune to pressure. Let's move to question 4. What do DMart's latest financial results say for the last full year, FY25, and the most recent quarter, Q1 FY26 reveal about their current performance? Are there any cracks appearing?
Okay, let's look at the numbers. For the full fiscal year 2025, that's FY25 on a standalone basis, Avenue Supermarts, which is DMart's parent company, reported revenue of about 57,790 crore.
Which is up from the year before.
Yes, up a healthy 16.7% year over year. Net profit was 2,927 crore, also up by 8.6% year over year, so still growing.
But yes, we started to see some margin pressure emerge in FY25. Their EBITDA margin, that's a key measure of operational profitability, dipped slightly.
Yeah.
It went from 8.3% the previous year down to 7.9%.
Okay, a small dip. A net profit margin.
That also compressed a little, ending up at 5.1%. Not drastic, but noticeable.
What caused that pressure? The company pointed to a few things. Growing investments in their e-commerce arm, DMart Ready, rising employee costs, which is happening across the board, and also just the natural effect of new stores taking time to reach peak profitability. They call it store maturity drag.
Right, those patient investments we talked about.
Yeah.
Okay, so that was FY25. What about the very latest, Q1 of FY26? These results just came out today, July 11th, 2025.
Indeed, hot off the press. So for Q1 FY26, on a consolidated basis this time, revenue continued to grow strongly. It rose 16.3% year-on-year to 16,359.7 crore.
Strong top-line growth again, but what about the profit? Did the margin pressure continue?
It did. In fact, net profit was almost flat compared to the same quarter last year. It came in at 773 crore, which was actually down, just slightly, by 0.1%.
Flat profit despite 16% revenue growth, that definitely signals margin compression. Did the CEO give reasons?
Yes. Mr. Neville Norenha, the CEO and managing director, gave some specific insights. He said revenue growth itself was negatively impacted by about 1 to 1.5 percentage points. Mainly because of high deflation in the prices of many staples and non-food items. So prices for some key goods were actually falling.
So even if they sold more volume, the value didn't rise as much. Interesting. What else?
Continued intense competition in the FMCG space, particularly, he mentioned, from the quick commerce players.
Like Blinkit, Zepto.
Yes, yeah, those guys. Exactly. They're putting pressure on everyone. And finally, higher operating costs. DMart is spending more on improving service levels, building capacity for the future, and facing inflation in entry-level wages.
So a mix of external market factors like deflation and competition and internal investment costs.
Precisely. It paints a picture of a company still growing, but facing definite headwinds on the profitability front right now.
Despite those headwinds, are they still opening stores?
Yes, the physical expansion continues. They added 9 new stores just in this last quarter, Q1 FY26. That brings the total count to 424 stores as of June 30th, 2025.
Okay. And how are the older, more established stores doing?
That's a good metric to watch the like-for-like growth. Their stores that have been open for 2 years or more grew by 7.1% in Q1 FY26 compared to the same quarter last year.
So the core mature stores are still delivering solid growth. That's a positive sign within the overall picture.
It does show the underlying strength of the model in established locations, yes.
Okay, this financial picture, especially the mention of quick commerce competition, leads nicely into our 5th question. What would you say is DMart's main Achilles heel in today's evolving Indian retail landscape? Where are they most vulnerable?
I think it's pretty clear it has to be what we could call their digital dilemma. Or simply, they're lagging behind in the omni-channel rate.
Omni-channel meaning?
Meaning seamlessly integrating the online and offline shopping experience. And DMart, well, they're just not really there yet.
You see that most clearly with DMart Ready, their online delivery service.
Absolutely. Look at its limitations. The delivery footprint is still quite small, only operating in about 25 cities last check.
Compared to national players.
Right. And the user experience on the app or website, it's generally described as functional, maybe, but clunky. Not very intuitive or engaging.
Basic.
Very basic. There's minimal tech-driven personalization, no sophisticated loyalty programs integrated online, not much social media buzz or communication. It feels like an add-on, not a core part of the strategy.
It's like, as we said before, having this incredibly efficient engine in the physical stores, but the digital side is sputtering a bit.
That's a good way to put it. And this lag is really noticeable when you compare them to the competition.
Who specifically?
Well, you've got the big players like Reliance with GeoMart, which is pushing hard on omnichannel. You have Amazon and Flipkart, of course. And then increasingly, the quick commerce platforms Blinkit, Zepto, Swiggy, Instamart.
And they are capturing attention, especially in cities.
They really are. They're grabbing market share, but maybe more importantly, they're capturing mind share, particularly with the urban shopper who values convenience, maybe even above absolute lowest price sometimes.
So the challenge for DMart isn't just about offering delivery.
No, it's much deeper than that. It's about adapting to a fundamental shift in consumer behavior. For many people now, especially younger demographics, The physical store isn't the only place, or maybe even the main place, they discover products or make transactions. The journey starts online or on an app.
And DMart isn't really part of that online discovery conversation yet.
Not in a significant way. That's the Achilles heel.
Okay, that contrast with competitors is stark. Let's broaden that out for question 6. How does DMart's overall strategy fundamentally differ from its typical competitors? And crucially, why is their model seemingly so difficult for others to copy?
Right, let's crystallize those differences. We've touched on many, but laying them out side by side is revealing.
Okay, let's do it point by point. Property.
DMart owns 90%. Competitors, primarily lease. Big difference in operating costs and long-term stability.
Pricing.
DMart, everyday, low price. Consistent, stable, low. Competitors, high-low model. Rely on promotions, sales events, more volatile.
Supplier term.
DMart, cash first. Pays super fast, gets better terms. Priority supply.
Okay.
Competitors, standard, often slower payment terms. More transactional.
Engine.
DMart, cluster-based. Slow, steady, focused on regional saturation and profitability. Competitors, often aggressive, rapid, pan-India rollout, chasing market share.
Advertising.
DMart, minimal. Relies heavily on word of mouth generated by low prices. Competitors, heavy spend on advertising, marketing campaigns, celebrity endorsement.
Private labels.
DMart, deep focus, a significant part of their offering, driving margins. In some lines, it's over 50% private label. Competitors usually have some private brands, but generally much more limited, heavier reliance on national brands.
Wow, when you list it like that, it's like they're playing a completely different game.
It really is a fundamentally different approach to retail.
So the second part of the question,
Yeah.
why don't others just copy it if it's so successful? It seems logical, lower costs, consistent prices. Why is it so hard to replicate?
Because it's not just one thing you can copy. It's the entire system, and more importantly, the discipline required to stick to it year after year.
Discipline how?
Well, first, the real estate ownership requires massive upfront capital investment. That's a huge barrier right there. Most companies prefer an asset-light model.
Okay, capital intensity. What else?
Culture. You need a deeply ingrained operating culture focused relentlessly on cost savings and efficiency from the CEO down to the shop floor. And crucially, you need the discipline to avoid the temptation of promotional spikes.
Resisting the urge to have a big sale to boost quarterly numbers.
Exactly. It's easy to chase short-term market share gains with discounts. Sticking to EDLP, even when competitors are shouting about sales, requires immense strategic patience and a focus on long-term sustainability. It's hard to build that culture and maintain it. It takes years.
So it's a combination of capital, culture, and long-term discipline that makes it tough to imitate.
That's essentially it. It's not a strategy you can just switch on overnight.
Right. Okay, that brings us to our 7th and final question. Looking ahead, given everything we've discussed, the strengths, the weaknesses, the competition, what critical adaptations must DMart make? How can they navigate the future of Indian retail and maintain their leadership without, diluting the very things that made them strong?
That's the multi-billion-dollar question, isn't it? I think looking forward, their growth in urban centers, where a lot of the future retail growth is expected, will heavily depend on DMart Ready.
Their e-commerce arm.
Yes. It needs to become significantly more competitive. The current limited footprint, the somewhat clunky user experience, that probably won't be enough as digital commerce becomes even more central.
So a major investment needed in the digital side.
It seems unavoidable if they want to capture that urban growth effectively. And then there's the physical store side.
Still growing, but
that cluster-based expansion, while profitable, might eventually hit saturation points in established regions. To maintain strong physical growth, they'll likely need to accelerate replicating that cluster model into newer geographies, which, again, requires capital and management focus.
And what about the customer? Are expectations changing?
Definitely. You have younger consumers coming through who've grown up with digital convenience. They might still appreciate low prices, but they might also increasingly expect better in-store experiences, more seamless offline integration, better communication. Their definition of value might evolve.
So DMart needs to adapt to those changing expectations too.
I think so. The core challenge for DMart, as I see it, is figuring out how to sort of layer agility and maybe a better customer experience onto their incredibly efficient base.
Agility onto efficiency. That's a good phrase.
They need to upgrade their tech infrastructure, not just for logistics, but for customer interaction.
Yeah.
They need to rethink customer engagement beyond just the price tag. But the absolute key is doing this without compromising that core cost advantage that defines them.
Don't throw the baby out with the bathwater, essentially.
Exactly. It's about defending their hard-won territory from this ongoing wave of digital disruption while carefully evolving to meet the future. It's a massive balancing act.
What an incredible journey exploring DMart. It's really clear after this just how efficient and disciplined this retailer is. It's built on such solid foundations volume, trust from the customer about prices, predictability.
They really are masters of eliminating unnecessary cost and complexity.
Yeah, but as you said, there's that central tension now that their core value-seeking customer base is still there. It's rock solid.
But that very same customer is also becoming more digital, expects things faster, is exposed to more choices, more demanding perhaps.
Right. And DMart's future really seems to hang on how well they navigate that crossroads, bridging their traditional strength with these new market realities.
It's going to be fascinating to watch.
Absolutely. Well, hopefully after this deep dive, you, our listener, feel like you've got a much richer, more comprehensive understanding of DMart, way beyond just a news headline. That was the goal.
We covered a lot of ground, from strategy to financials to the future challenges.
Indeed. So let's leave you with a final thought to chew on. A provocative question, maybe.
Okay. How about this? What does it actually mean for the definition of value in retail? If even the most disciplined, cost-obsessed players like DMart find themselves needing to embrace speed, digital convenience, maybe even a bit more experience.
Does value purely mean lowest price anymore? Or is it evolving?
Exactly. What stands out to you as you think about DMart's next chapter? What do you see as their biggest challenge, or perhaps their biggest untapped opportunity? Something to think about.
I hope you've enjoyed this deep dive as much as we have, and I hope you'll join us next time for another fascinating exploration of the business world.
Until then, keep exploring, keep learning, and keep diving deep.